Hello and welcome to our May 2025 quarterly macro and markets update featuring our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer here at Pointe, and I will be your host and moderator today. We've got a lot of timely and important material to cover, but before we get started, just a few housekeeping notes. We set aside 90 minutes for today's session, and we will be reviewing more than 70 slides and covering a broad range of topics. Many of you have submitted thoughtful questions in advance, and we will also encourage you to ask questions during the webinar. Just type them into the Q&A box at the bottom of your Zoom screen, and we'll do our best to answer them throughout the presentation. If you'd like to revisit anything we discussed today, a full recording of the webinar will be available at beaconpointe.com/videos within 24 hours. So what's on the agenda today? We will begin with the review of the first 100 days of the Trump administration, focusing on key policy developments. Next, we will take a deep dive into the US economy, inflation trends, and the Federal Reserve latest moves. In the third section, Michael will explore why budget deficits and the national debt matter more than ever. Then we will explore the growing challenges of the US dollar status as the world reserve currency. And finally, we'll wrap up with portfolio positioning strategies in today's volatile environment. With that, let's welcome in our Chief Investment Officer, Michael Dow.
Thank you, Julien, very much. And thanks, everyone, for attending. There is quite a bit of things we could be talking about today. Julien mentioned that we have a chat or a Q&A. Please put your questions in the Q&A, and we'll try to get to them as we move through the presentation. And this presentation will be available within 24 hours or so on our internet. So look for that in about 24 hours. I always, and again, thanks everyone for joining. I like to start this presentation by reminding folks what investors care about when approaching the markets and asking the question, what do we really need to know about? And generally speaking, you want to know where you are in the economic cycle, what the inflation dynamics are, and where you are in the economy, and other factors will lead you to a view about corporate profits, which tells you that the equity market is either rich, cheap, or fair. So what I want to say is there's only three things that you should be focused on, and identifying what the economic outlook is, what the inflation dynamics are, what the Fed is going to do, and where corporate profits are headed are those three things. Just to put a fine point on it and to start with a conclusion, we've been debating within our investment committee here at Pointe whether the outlook is for a no landing, which would mean no recession, no slowdown, just kind of a steady as she goes, probably would cause the Fed to need to get re-engaged in either for an extended pause with rates higher than the neutral rate, or even a rate hike. A no landing is a pretty good baseline scenario. A soft landing is the Goldilocks. That's the best scenario. Recession, of course, not so great, and stagflation might be a persistent stagflation would be the worst of all possible worlds. We don't think we're going to see that, but a lot of the policy announcements since in the first 100 days of the administration have led us to determine the most likely outcome is a cyclical outlook defined by a whiff of stagflation with a small s. And that small s indicates that it's not likely to persist, but that we're likely to see hard data that corresponds to the soft data, suggesting an economic slowdown and the potential for slightly higher than comfortable inflation, which is our starting point. The Fed has not achieved a soft landing, hadn't achieved a soft landing. Interest rates remain above the neutral rate, and inflation remains above the Fed's 2% target. As a result, a soft landing could not be declared. And what I think we're going to see in coming months, not quarters, but coming months, is the Fed is going to remain on pause to assess the economic implications as it relates to the economy and supporting the labor market, which is one of their mandates, and the inflation dynamics, which is their other mandate, price stability and to see what they ought to do. And that the most likely scenario is that the policy uncertainty that we're seeing causes a slowdown that forces the Fed's hand to intervene, to continue the rate cutting cycle that began last September in order to support the labor market. That would be our base case today. And barring a significant economic slowdown or other exogenous shock, and there has been a few, so it's not beyond question, it appears corporate profits are likely to remain resilient, again, as long as we don't slip into a recession. It's the answers to these questions: what's the outlook, what's the Fed doing, and how do you feel about corporate profits, that allows us to position portfolios to both protect client assets on the downside and to take advantage of any opportunities we see on the upside. You know what's not on this list? Politics. You know what else is not on this list? Policy noise. Our job is to try to figure out what the signal is through the noise. So you're going to hear a lot about policies today, and not so much about politics, because that's what we're focused on. You can't make money if you're a partisan. It's very difficult and challenging. You've got to remove yourself from a lot of the emotions that swirl around politics, and try to hone in and try to develop the necessary information sources and resources to find out exactly what's going on in the world as it relates to implementable fiscal and monetary policies. We're going to talk a lot about how the policy mix that we see is most likely will affect the economy on a bunch of different levels. We always go here and start with the global environment. On the left is the global PMI, or Purchasing Manager. It's a global activity index. The orange is related to services. The blue is related to manufacturing. Anything above 50 would be viewed as an expansion. Below 50 is a contraction, and we're right on the razor's edge. So global activity is somewhat less supportive and expanding. If your services expanding at a lower rate, and if you're manufacturing, just barely into the contraction zone. And that's a little troubling. So we've got that coded as a cautionary, in caution with the yellow. What we're looking at on the right-hand side is the monthly PMIs in a format that suggests that you can see where the trends are over the last 24 months. In terms of the global environment, you're seeing a slowdown. It's a slowdown in developed, a slowdown in emerging, and the U.S. is now printing a bit of a red flag here. And we saw that in the GDP number that was presented last week. But that GDP number doesn't fully represent the actual economic outlook. So what do we got here? Is a year ago, we saw the peak of monetary policy. And since then, there's been a tremendous amount of central bank activity, primarily supporting economies as the fight against inflation globally was won. Inflation was coming down, and now we're seeing a lot more rate cuts, whether you're talking about developed markets in the blue or emerging markets in the orange, substantially, kind of 10 times the amount of, or 20 times the amount of cuts versus hikes, or 6 times if you're in emerging. That's in the last year. And clearly in the last 3 months, the momentum is still much greater for rate cuts than it is for rate hikes. And you can see that in the trajectories of the average central bank rates that are the basic building blocks of the funding costs of these economies across the world. It's important, as this number comes down, that's supportive to the economy. Central banks raise rates when they're trying to slow economic growth. In the developed markets, the slope of the developed market average central bank rate, which is down 130 basis points from its peak about 17 or 18 months ago, seems to be accelerating. This can be taken as potentially a warning sign, as you see global central banks around the world be more concerned about supporting the economy than fighting inflation, and they're lowering interest rates or normalizing interest rates as a result. We're seeing rate cuts all over the place. The Fed was on pause yesterday, citing uncertainty about the outlook as it relates primarily to trade policy and other cross currents that we're going to dig into. Looking at the U.S. And some of the factors that affect economic growth in the future, which would be the financial conditions indices and the market data. This is where we were coming into 2025, or when we last spoke in February during our last macro and markets webinar. So this is where we were 3 months ago. where real GDP looked pretty steady, CPI was slowing, personal consumption expenditures steady. Fed funds were stable, 10-year yields are high, and so somewhat restrictive, but the S&P was on a tear, and that was very stimulative, along with international equities, also very stimulative. So broadly speaking, you've got more green than any other color. Let's just fast forward to the current snapshot for the macro environment. The real economic data has done a 180 to a certain extent. Real GDP, we saw the print last week, first negative GDP print in a while, but probably not as bad as it looks. We'll talk about that in a second. The CPI outlook, the forecast for CPI, which was trending lower, is now forecast to be slightly higher. And a lot of the things that were likely to contribute to economic growth in the future, which would include, again, financial conditions, that's the Fed funds rate, 10-year treasuries, corporate bond spreads, economic or equity volatility and equity prices, all of the things that might contribute and be supportive or stimulative to the economy are now kind of in a orange or red. And looking just a little more deeply into US GDP, the components of GDP, the only thing that's on the board here with a stimulative, positive economic impulse is likely to be government spending. So what we're going to try and do is address some of the questions here that we think are key for navigating the current environment here in 2025 as we stand in May. First question, really important: are we going to avoid a recession, and how, and more importantly, when will the policy uncertainty be resolved? It's the most important question I think we can try to answer. And I'm just going to tell you, our view is there's a pretty wide band of outcomes. The number of outcomes, the scope of the outcomes has expanded pretty dramatically since the inauguration on January 20th. And we don't anticipate necessarily that the volume of policy pronouncements is likely to decline, but I'll give you the conclusion. It's probably peaked, but we'll get to that in a moment. We should expect to see, I think, some de-escalation of the volatility around trade policy. We saw some progress today in the UK the trade announcement, which was announced in the Oval Office with the ambassador from the UK and the US trade representatives huddled around President Trump to announce that we've done a deal with the UK. There's not a lot of detail there, and that's the important thing. It may not matter. It may not matter that trade deals generally take months, quarters, and sometimes years to hammer out all of the various details on the various intricacies and the granular level of detail that a true fundamental comprehensive trade deal generally requires. We're not going to see that in coming before July 8th. July 8th, by the way, is when the reciprocal tariffs, the 90-day pause on the reciprocal tariffs are likely to be either the tariffs will be reinstated or there'll be another a pause. Most likely, what you'll see is a lot of trade deals being announced between now and July 8th, which will give the administration an off-ramp to and a lot of victories to promote that will allow us to sort of reestablish a less cacophonous, can you say cacophony? Cacophonous, all right, Julian, if you can say it in French, probably easier than me saying it in English. The cacophony of noise that we're seeing in trade policy is likely to be much reduced. So the other thing I want to talk about, and we're going to spend the first 20, 30 minutes talking about policies and their implications for the environment, GDP growth, inflation, and the debt. What growth positive policies are in the pipeline? And the answer is there's some good news here. And frankly, if you're a Fed watcher like we are at Beacon Point, what the Fed is going to do in 2025 is likely to have a lot to say about, and why they're doing what they're doing will have a lot to say about whether or not to take additional risk. Julian, did you have a question?
Yes, I guess previewing the first section, obviously a lot of questions about the first 100 days of the Trump administration and the policies specifically, and with the key one being, the impact of tariffs on the economy and how do they actually, can you explain the mechanism behind the tariffs?
The mechanism behind the tariffs? So the tariffs are being implemented primarily through a rather novel legal theory where Congress has delegated a lot of the authority to the executive branch and to the president, and that began 80 years ago. Congress has sort of stepped away from tariff policy, trade policy, even though effectively a lot of what we think of trade policy is in effect tax policy. Tariffs are very straightforward at the border. When goods are coming in and there's a tariff being imposed upon a particular country or goods coming in from that country, the shipping costs include the additional 10. In this case, let's just use a 10% tariff. That's paid right at the border and goes right into the government coffers. And the key to understanding the implications for tariffs are, number one, that sounds good because it means government revenue is increased. That's good for the debt and deficit situation. On the other hand, countries don't pay tariffs. Tariff costs. If you're a U.S. importer and we're going to pay $100 for something, and now you're paying 110, that cost will be passed on in some way, shape, or form. Perhaps not all of it. The companies here in the United States, depending on the goods and the willingness or ability of consumers to substitute to lower cost goods, will dictate how much of the cost is being passed on, but it's not zero. So you can think of tariffs as being a source of alternative government revenue and as a tax on consumption and consumers, because it will increase the prices of goods that are imported. Was that the question?
Yes.
Does that sound? Yeah, I think that addresses it pretty conclusively. Anybody else has any other questions about that? Don't hesitate to throw them on or contact me after. Let's jump right into the first 100. Okay. First 100 days, we're at 8 days now. In the first 100 days, we had 130 executive orders, 3 times the executive orders of Biden, 4 times the executive orders of Trump 1. And I compare the number of executive orders to the approval rating for every president that's had a second term and has had an April of a second term. So this is the April of the first year of your second term approval rating. So you got Eisenhower, Johnson, Nixon, Reagan, and I'm highlighting here that the percentage approval rating, which by the way has never been very high for the current president, is not high right now, but it was hanging in there as of about a week ago. The average across all presidents who've had a second term in the month of April is about 54%. So this is an important metric to keep an eye on. The ability of the administration to accomplish their policy priorities is going to be constrained by certain things. And we'll talk a lot about the constraints and the facilitation of policy implementation on the next slides. But you can think of constraints, broadly speaking, as being the courts, the markets, and frankly, the midterm elections in 2026, and that has a lot to do with presidential approval ratings. So we're gonna talk a bit about that. Here's what I want to start with, though. Here is a outlook for GDP and CPI. So the economic outlook, which is in the blue here, was rising heading into the end of 2024. So this is fourth quarter of 2024. This is the first quarter of 2025. Kind of ignore the slide on the right for a second. On the left, what you see is after the election, GDP and the CPI forecasts for 2025. These are forward-looking forecasts as of the election and as of the inauguration. What you saw was both inflation forecasts and growth forecasts were ticking upwards. And that's a reflection of the fact that the policies that were prioritized by the Trump administration during the campaign had both positive growth aspects and negative inflationary aspects. So the market was starting to incorporate those into the outlook for 2025. What happened was after the inauguration, things were buzzing right along till the beginning of April, and then we had the Liberation Day announcements, and almost instantaneously you saw the outlook for inflation spike up 60 or 80 basis points, and the outlook for the economy fall very, very dramatically, very rapidly. So these are blue chip economists' forecasts for 2025 post-Liberation Day, and with this combination of higher inflation and lower growth, clearly that's a decisive move to something called stagflation. Is it going to last? I don't think so. I think the impact of the Liberation Day announcements is already starting to fade, and I think the administration has bumped right up against what I would call a binding constraint on their ability to implement heterodox or non-orthodox economic policies via the bond market's reaction. And we're going to talk a little bit about that in a second. So let's review what the policy priorities of the administration are and how they're going to affect the economy and how that feeds into our outlook for risk-taking and markets throughout the remainder of the year. So what do we got? We got positive growth policies, and we have policies that are likely to be negative for growth. And we have policies that may be ambiguous for growth and the debt deficit. I think it's important to highlight that the border has been effectively closed. The good news is that was a significant campaign promise from the administration. It may have implications for inflation, higher inflation, with lower labor supply going forward. Lower labor supply, that is the jobs that were being done by folks who were immigrating to this country. If that supply of labor is no longer there, it will put upward pressure on wages, and that will cause prices to rise as companies raise prices to compensate for higher input costs, particularly labor or wage costs. So immigration is you could get a green check mark if you're scoring at home the promises that were being made by the administration. Border incursions have fallen to near zero. All of the top four policies, immigration, trade, cost cutting through DOGE, and the Federal Reserve, the implications for the Federal Reserve, the administration's willingness to go out of their way to make known their desire for lower interest rates, which infringes upon, I think, the Fed's independence. These are all what I would call growth negative, likely growth negative policies. And this is what we focus most of our time on, is trade policy, cost cutting, and tweets about Jay Powell. I think the president called him Mr. Late again today after the Bank of England and other central banks and the ECB have lowered rates recently. China's lowered rates. So that's those are all growth negative. If you infringe on the Fed's independence, I believe, beyond tweets, you're probably going to have to reckon with a bond market riot, which would also cause the stock market to go down pretty dramatically, and that would definitely be growth inhibiting. So all of these policies here, I would suggest, are the ones that we've heard most about in the first 110 days are pretty much growth negative. If you're talking about extending the tax cuts and lowering corporate tax rates, maybe that gets done, maybe not, and other tax policy goodies, that's going to be a growth positive. And one of the bigger ones, and the one we're not really talking about much, is deregulation, especially in the finance and energy sectors of the market. These can be implemented. Many of them can be implemented via executive action. Taxes need Congress, and that's what's going to get worked on over the summer. So you're going to hear a lot more about taxes, and you're going to hear a lot more about deregulations, particularly as it relates to implementing the Basel III capital and supplementary liquidity ratios and other things that we'll talk about in a second. Will have probably have very positive growth and enhancing features. The administration clearly is moving very quickly to address these policy priorities. It's felt like a flood the zone or shock and awe, and that's certainly been felt by many in the markets. It's been a little disorienting, and certainly the market has reacted in many cases in a very volatile way, both down and up. We saw that April 2nd announcements. April 3rd and 4th were very big down days in the market. April 9th, when the reciprocal tariffs were paused, was one of the biggest up days in the history of the stock market. So you're seeing a lot of whipsawing, and that's what I said earlier. One of the things that we as investors are trying to do is to make sense of the policy pronouncements and to try to tease out the signal from the noise, because there certainly has been, I think, a lot of, especially if you pay any attention to market pundits, there's been a lot of noise. Let's put a fine point on it. What do each of these policy priorities, immigration, trade, cost cutting, the Fed, independence, taxes, and deregulation, what does it mean for growth? Generally speaking, as I mentioned, the first four are what we've been focusing on in the first 110 days of the administration. The last two are going to come later, and they're growth positive. In terms of inflation, there's not a lot of good news here. Growth positive policies in a world of very low unemployment are generally inflationary. Deregulation it's kind of ambiguous. If it's red, it's negative for the economy. Green means better inflation, lower inflation. Red means higher inflation, growth lower, growth higher. And then blue means ambiguous. I also wanted to highlight what we think the implications are, maybe for the longer term. What we're talking about, growth and inflation, is really short term. But the real elephant in the room has to be the debt and the deficit situation. So how do these things affect debt to GDP ratios, which are really one of the very important things that you want to maintain, focus on, and manage if you want to be the world's reserve currency? If you want to be a safe haven asset, you really do need to make sure your fiscal house is in order. So debt to GDP, immigration, trade, probably ambiguous. Cost cutting is unambiguously positive for the debt to GDP, as long as it doesn't cut the bone, as long as you're cutting waste and fat, which is hard to identify, and to do so in a quantum that will actually affect the budget deficit, very difficult. Tax policy is not going to be good for budget deficits, but deregulation is likely to spur growth, so that will improve the GDP outlook. So summarizing all of the policy implications and just kind of trying to get to some measure of an aggregate score on the policy priorities of the administration. Broadly speaking, positive for growth. Broadly speaking, a little negative for inflation, which, by the way, if you want to think about how to reduce the debt level here in the US, running inflation a little hot isn't a bad way to do it. If you pay down your debt with, increases in nominal GDP, which includes inflation, you pay down the debt that's already been established in real terms. So this is kind of, but the tax policy overwhelms a lot of this. So progress on the debt and deficit. Here, that's the good news. If you add policy uncertainty to the mix, and we are certainly in a world of substantial policy uncertainty, that flips things around a bit. It actually diminishes the positive growth aspects, which, by the way, if you're not going to grow as fast, is probably a little better for inflation, but it completely ruins any benefits that you might see on the debt and the deficit situation. So what I want to say is, I think what you want to do is eliminate the policy uncertainty. Let's get to some trade, tax, cost cutting, and deregulatory policies that are well understood, clearly articulated, and you're going to do better in the long run. It may be that this administration wanted to move fast and break things, but when it comes to actually achieving some of these economic goals that and the market goals that the administration does have in the back of their heads, for sure, then you gotta think about removing some of this uncertainty. We think that we've seen the peak. Julian.
I guess the answer is on the slide, but maybe you can reiterate how does DOGE affect the U.S. economy overall?
So far, it's been broadly. So here, let me answer it this way. It's a good effort. Strategically, no one can argue with the attempts to find waste and fraud. Problem is, if the waste and fraud was so easy to find, it might have been rooted out already. And waste and fraud is sometimes defined by your political perspective. So if the reality of DOGE was to try to put the U.S. on a better fiscal footing, that's not going to happen. And it won't happen simply because the numbers are just too extreme. And the only place where we have any kind of leeway in terms of cost cutting in the U.S. Budget, the government budget, is in the entitlement program, Social Security, Medicare, and Medicaid. So what DOGE has done, unfortunately, is cast a pall on consumer sentiment because of the blast emails and the firings. That has made consumer sentiment decline pretty meaningfully, not just in the DC area but beyond. In addition to some of the volatility in the equity market, these things are all together. So I would say DOGE is a good effort strategically. Tactically, it may have been necessary to, again, move fast and break things just to get a few, maybe get some wins on the board. But it's not going to be the thing that causes the U.S. to balance the budget. The only way the U.S. is ever going to balance the budget is by reforming and the entitlement programs, maybe raising the retirement age, for Social Security and other entitlement programs, including Medicare and Medicaid. It's not going to do it. It's a good idea, but the numbers don't support the fact that it will be budget deficit reducing. That's the facts. Speaking of the administration, it's important to note, especially given a lot of the conversations that I've had, and again, we're going to see a slide that shows that your consumer confidence level, if you're a consumer, and everyone's a consumer on the call, your confidence level depends almost entirely on your political affiliation. So for those that are concerned that the administration is moving too quickly or not quick enough, either way, this is the way we see the playing field. So it's important to note what's implementable and what the constraints are. And the constraints aren't, what's the word? They're binding in many cases, especially the markets. So the administration clearly has taken the approach that they're going to try and expand the limits of executive authority. And the first constraint that we bumped up against, particularly for the policies related to immigration, cost cutting, and the Fed, we haven't seen really a test of the Fed in the courts, but you would get one if the president tried to fire Jay Powell. It would certainly go immediately to the court system. But what you've seen is the administration's testing the limits. The courts have gotten involved with various parties bringing lawsuits. This is back and forth. The administration is responding. It's moving through the chain from district to the Court of Appeals, and in some cases to the Supreme Court. And the administration has won some and has lost some related to immigration, cost cutting, and the Federal Reserve. Now, the biggest constraint that the administration faces, and this is a binding constraint, has been the markets. I think the administration found the limit of heterodox economic policy on April 2nd, when they announced the reciprocal tariff policies. It was, I've not met anyone or spoken to anyone, either clients, primarily clients, but mostly policymakers in DC and and in New York, with some of the folks that are highly attuned to what's going on, that has said to me that they felt like the announcements on April 2nd were effective. Clearly, the stock market had a very negative reaction on both April 3rd and April 4th. And more to the point, the bond market had a pretty visceral and negative reaction to the policy pronouncements that were I can't imagine that they were that well, they weren't that well articulated, and I'm not sure they were that well thought out. I think what we saw there was an attempt to see what, again, let's see what happens. It was kind of the approach. And as it relates to trade policy and Federal Reserve policy, you're going to get a reaction from the markets, and you saw it, and it was binding. Congress is also a constraint or a facilitator. Congress will either constrain the administration in trade, and on taxes in particular, I suspect that Congress will facilitate. Here's the most important thing. When it comes to taxes and cost cutting, that's where Congress needs to get involved. But so far, I want to say these are, to scale. If you want to see kind of the hurdle rate or how high the hurdles are to implement some of these policies, the markets have been the most binding, and that's kind of refreshing, to the extent that we shouldn't expect that that the market would ignore or just take all of the negatives and go. The markets never just take the negatives. It's a weighing and a balancing machine for future expected policy and economic outcomes. So the markets are there to do their job, which is to take in all the information and to try to make the best judgment about where capital should be deployed. I want to make sure everyone understands everything we talk about as it relates to policy constraints and facilitation has to be viewed in the context of presidential approval ratings with an eye towards the November 2026 midterm elections. The 2026 midterms are the place where the president needs, if he wants to retain control of Congress, and he does, and more often than not, if you're in control of the House or the Senate, and your party is also in control of the White House, you will lose seats in the midterm. It's inevitable. In fact, it's generally 20 to 30 seats in the House and 3 to 5 seats in the Senate. Those two margins of marginal differences would cost the administration, the Trump administration, their current very razor thin majority in the House and in the Senate. The House is a couple of seats and the Senate is a couple of 3 seats. So it's not a big majority. And the president will want to maintain that majority so he can make sure the rest of his legislative agenda is it can be implemented. But he won't get that if his approval ratings are very low. So keep an eye on presidential approval ratings. I'm going to talk very briefly about some of the things we were talking about 90 days ago. Here's what we thought we knew, by the way, in Feb. Just going back 90 days, very quaint notion that maybe the average proposed tariff rate might go to 7%. Well, we got the Liberation Day announcements and things went to 20. If you're going to put some money on it, and I think, basically investing is making a forecast and a bet and trying to navigate through it, I think 15% is the likely number for the average tariff rate. Not as high as 20 or 22, which in some of the estimates were higher than that, but much higher than we've seen since the Smoot-Hawley tariff acts back in the Great Depression. So this is a history of tariffs in the countries going back to the 1820s, and for the last 100 years we've been below 10%. We're probably going to 15. So we'll have to see if it's 15%. By the way, it appears the government, and this is going back to the 1930s. This is the dollars of alternative government revenue or tariff revenue that will go right into the government's coffers, all else equal. All things aren't always equal, though. If you raise tariffs, imports tend to go down. But if you keep imports at 14% of GDP, and it's increased dramatically. So back in the 70s, only 4% of goods were imported. Now it peaked at 17 10 years ago, 15 years ago now. But 14% of the U.S. GDP is imports. You can raise a lot of money with small changes in the tariffs. So we were raising close to 80 billion in tariffs, now closer to 450 billion. So it is meaningful. It would be a lot if it's stuck, but again, all else is not equal. But this is the thing I mentioned earlier. Tariffs do act as a tax, revenue for the government, but also a tax on consumers. So if you look at the history of tax increases or tariff increases, all of these other from 85 to 1968, which was the biggest tax increase on record. This is tax policy, not tariff policy. All the blue is tax increases. Only the orange relates to a sizable tax increase because there's not one in the last 50 or 80 years that you could look at and say, oh, that tariff increase was going to be meaningful. But as a percent of GDP, if you got to 15%, it would cost 1.2% of GDP, and that's effectively the biggest tax hike we will see. So that's why I said it's growth negative. That's why it's growth negative. So again, what we want to do, and I said it in a slide earlier, all of the policies of the administration, if articulated clearly and you can assume that they will remain in place, would remove the uncertainty that is dampening significantly both household and really more specifically business or company activity. Company activity, is sentiment indicators. Survey data suggests that most companies that have the ability to pause hiring, pause buying, pause investing, buying working capital, raw materials, whatever, they're all pausing to see what the outcome of the tariff policies are. And that's not a Nobel Prize winning idea. Uncertainty, economies hate uncertainty, markets abhor a vacuum of information. And what we're seeing right now is what you would consider a rational economic response to policy, to a relatively uncertain and incoherent policy mix. Until you get some certainty, until you get some clarity, until you know where terra firma is, you're not gonna act boldly. And unfortunately, Keynes would tell you animal spirits are required to overcome the dark forces of the future that inhibit economic activity. And right now, we've just sort of included or increased the cloud of uncertainty. So we need to get rid of that, and that's going to go away. I feel pretty strongly about it. I think potentially what we saw in the first 100 days, if it is the peak of uncertainty, if it's the peak of volatility, it's because perhaps the administration was looking to put a flag in the sand from a negotiating perspective, take a position, and then negotiate from that position. That was our view. We actually added to risk in our discretionary accounts for the OCIO, for the institutional discretionary accounts. We added to risk on April 4th at the close because this has been our view throughout the quarter. And being able to act very quickly on these things is very beneficial for our institutional clients that don't have to worry about taxes and things. So just so you know, this is what we were thinking about. So far, it's proven about correct. I mean, today with the stock market up 1.2% plus or minus, we're back to levels and slightly above where we were on April 2nd, after right just before the Liberation Day announcement. So policy uncertainty, which by the way, this goes back 10 years. This is the original Trump 1 trade war. Policy uncertainty was barely a bump. Even during COVID, policy uncertainty was not very high. But what you're seeing now is kind of off the charts policy uncertainty. If you combine economic uncertainty with economic activity, and you put economic activity on the an inverted axis here. So economic activity is this blue line, that's domestic investment. And then policy uncertainty is inverted. So policy uncertainty, this means much higher policy uncertainty. You would expect economic activity to sort of follow suit. This just goes back 40 years or so, and you could see economic uncertainty, it goes hand in hand with economic activity. So as long as you get this increase, which is policy uncertainty up means pointing down because it's inverted. So this is a massive increase in policy uncertainty. We should expect to see economic gross private investment decline as a result. And that's again Econ 101. Now, it's not all I'm going to talk about the good news in a second. What we're doing here is looking at the estimated effects on employment, PCE and GDP of the tariff policy. Generally, this is the baseline, by the way, is the blue. 4.5% unemployment, 2.6 estimated inflation, and the most recent GDP number is -0.3. So what we got here is the estimated effect of tariffs on unemployment is to increase unemployment, increase inflation, and take GDP down. If you run the same analysis as Nick Coletta, our senior analyst on the macro side here at Beacon Point, did, what you find is the tax extension effects are to lower unemployment. That's good. Inflation goes up a little bit, but GDP also goes up, pretty meaningfully. So the effective tax policy we estimate to be positive. I'm going to leave this as red because maybe we know that one of the constraints we talked about is the administration's job approval rating is started out pretty positive for a couple of spots. Inflation has never been positive, and it's just kind of gotten worse. But keep an eye on these statistics because this will tell you just how far the administration can go. And to kind of wrap up on the first 100 days, I'd say, the market performance is important to note. Here's you've got Liberation Day right here. Stocks were down overall. Since January, the beginning of the year, international stocks are up 9%. U.S. stocks we're down 7%. That's as of 2 days ago at the close. Interest rates are down, generally speaking, but they've been very volatile. And that's where you see volatility. Volatility peaked on April 3rd, 4th, 6th, 7th, something like that, with the VIX index, the fear gauge, way up. It's still up versus where we began the year. Interest rate volatility is high too. This is something we're going to come back to. Commodities, Bitcoin up 24%. These are some of these things can be viewed. Oil and Bitcoin maybe not. Bitcoin's down a little bit. It's actually probably closer to flat now as risk returns. Oil's down 22%, so that's a plus for consumers. But Bitcoin or gold as a substitute for the U.S. dollar is up pretty meaningfully this year. Something to note. Here, I just want to say one more thing about deregulation and the impact on the economy. There's something called the Basel III Endgame, which would take an entire seminar to discuss. But what I want to show here is the bank average. This is money center banks. These are like Citibank, B of A, JP Morgan, Goldman Sachs, Morgan Stanley, Wells Fargo. If you look at the major U.S. banks' return on equity before the Great Financial Crisis, this goes back 25 years. If you look at, the Great Financial Crisis was here in Basel III, which are the new capital requirements restricting. The new capital requirements restrict lending. And if you restrict lending, you actually put the brakes on the economy. So the return on equity for banks, by the way, went from 17% down to 9% post Basel III. Basel III also raised the total Tier 1 capital requirements from 10 to 14%. By increasing capital requirements, you reduce lending and you slow the economy. So the regulatory environment that's known as Basel III has been growth negative. And if you don't do more of that, that is what we're teed up for starting in July, which will be delayed for sure, is something called the Basel III endgame. So you should look for some positive growth impulse from a deregulation or a lack of implementation of the Basel III endgame. Julian.
Just a lot of questions that to preview the next section really about, what are the probabilities you think of a recession and where's the U.S. economy going, in the next 12 to 24 months. And the other one, that we'll address is about the Fed and Trump, getting involved with, basically the Fed and trying, things with Jay Powell. What can he do when probably not fire him, but when the chairman is up for election in May 26th?
Yeah, I'll start with that one because it's probably the easiest one. There's a ton of uncertainty about where the economy's headed and what the Fed's going to do. There also seems to be some uncertainty about whether or not Trump will want to or has the legal ability to fire Jay Powell. If you ask Powell himself, he would tell you no. And if asked to resign, he would decline. But that doesn't mean it's the end of it. I do think the markets would, I think the Treasury Secretary and other economic advisors that have experience with markets would caution the president that removing a Fed chair, especially if his term's up in 12 months, is not likely to produce the outcome required. And that would be a more pliable Fed chairman. The next teed up might be, if he was able to effectively remove Jay Powell and the stock market went down 10 or 20% and interest rates spiked because the Fed, if the Fed's not independent, it can't maintain its inflation fighting credibility, and inflation expectations will become unhinged and interest rates will spike higher, and interest rates spiking higher will cause the equity market to decline dramatically. It would be a disaster if the president tried to remove Jay Powell, in my opinion.
So I guess if you assume that this is out of question, how could the president impact the election of the next Fed chairman? Is there anything he can do there?
How can he has the authority to appoint both Federal Reserve governors, not the presidents, but the Federal Reserve governors, of which there are 7. He has it's his authority to appoint them, but then they have to be Senate approved. So, and then he would nominate one of the Fed governors to be the chairman of the Fed. And that's something he will do a year from now, most likely, and it will most likely be Kevin Warsh as the new Fed chairman. Even if he swapped, Kevin Warsh in now for Jay Powell, he's going to get, he's the number one contender actually to be the next Fed chairman. He's an orthodox economist and understands the history and the purpose of the Fed and the Fed's desire to maintain its hard-fought independence and inflation-fighting credibility. So I get a lot of questions about the Fed chairman. I think it's mostly noise. It's not impossible that the administration would try to remove him, but I don't think they will, because I think cooler heads would prevail, because it would likely cause a recession if it happened, because the sudden stop, the economy, would look at the cost of doing business. The interest rates would rise and the equity market drop pretty meaningfully. And coupled with the uncertainty and policy uncertainty already, I think it would just do severe damage to our growth prospects, and also, frankly, to our safe haven status, which we should jealously guard by being better fiscally and by having a coherent monetary policies. So we can come back to that, but in terms of the GDP and inflation over the next 12 months, I mean, here's the March 2025 first quarter GDP decomposed. The headline number was -0.3. Negative GDP sounds bad, but note the disaggregation. Net exports subtracted 5% from GDP. If net exports were just the same level as 2 quarters ago, you would have had a significantly positive. Well, it's hard to say, because a lot of the imports that caused this net exports to be negative went into inventory. So the inventory build, leave the inventory build out and net exports out, and you have something, I think, that might be more meaningful to look at. And that would be something called final sales to domestic purchasers. So even though the headline number was 0.3 negative, the final sales to domestic purchasers, which takes out trade and inventory moves, was significantly positive, and the same as the prior quarter. So there are underlying strengths to the U.S. economy that aren't reflected in the negative GDP print we saw 2 weeks ago. So pretty solid. Now, GDP is a lagging indicator. This is economic activity from Jan, Feb, and March of 2025. Second quarter of 2025 is a different story. We don't know where we're headed there. The GDP forecast from blue chip economists is something on the order of 1% or slightly less for the next 2 quarters before a recovery back towards potential GDP of 2%. And inflation here, we've got, kind of a gentle, I don't know, you've got inflation kind of moving up a little bit. By the way, actual inflation is orange here, and the forecast is in the green. As for Fed funds, this is really important. I do think the Fed's likely to continue to lower interest rates, maybe starting in July, but maybe not till September, as it gently tries to, support the economy because of the slowdown in economic growth. So do we see a recession? No. We look at a lot of data. This is I'm going to leave this one as red and just move on to suggest that we summarize all of that data in a couple of metrics, a macroeconomic time series that Nick created, and I think is incredibly useful. This is the entire time series. It's pointing negative now. When it gets really negative, then you have a recession. If you break down this macroeconomic indicator into its component parts, it's comprised of financial conditions, leading economic indicators, inventory swings, which are generally have generally big impact on economic growth swings quarter to quarter. And here's the big one, sentiment. So far, everything is kind of rolling over. So that's why we expect a slowdown. And sentiment, which is the soft data that you see that can be translated into the harder economic data, the GDP data, has taken a real nosedive here. And that's partly because of policy uncertainty. So when you're asked a question, well, how do you feel about the future with policy uncertainty, you're gonna respond pretty negatively. So our data series and the models that we use to try to predict economic growth going forward are pointing to a slowdown, but not necessarily a recession. The probability of a recession from economists is doubled from 20 to 40%. Most of it's come since after the beginning of the tariff announcements in middle of March. I'm just going to say it. I mean, it does look a little like stagflation light, small s, especially after the Liberation Day announcements. But I do think that some of these, the economic data and first the market data, the stock market going down hard, interest rates spiking higher on April 7th, 8th, 9th. Those are the things that are going to constrain the administration to a certain extent and bring us back to, I think, not a completely placid or stable environment. We're never going back there while the current administration is in power. This is should not be expected. But you should be able to gain some comfort from the fact that there are constraints that are likely to be binding. Julian.
Yeah, I just wanted to add on that slide that we run some correlations of the probability of recession to the 1-year forward return of the S&P. And what's interesting and that's kind of intuitive is that, of course, when recession probabilities are low, you think that you get a lower returns, and as they go higher, you get better returns in equities because equities are a discounting mechanism. So when so it shows some positive correlation basically between equity returns and a probability of a recession with about a 0.4 ratio, which can sound surprising, but it's just because equities are a discounting mechanism. So basically, when you expect a high probability of recession, a lot of bad news are priced in, and then you get a surprise on the upside.
Yeah, I think another way of saying it is how you feel about how the equity market's going to perform over the next 6 to 12 months has a lot to do with what the expectations are for the economy today. So the reason we had such a nightmare 2022 is because nobody was thinking about a recession. So a lot of really good news was priced into the equity market. And by the same token, going into 2023, the probability of a recession was at 65 or 70%. and we didn't get a recession. And 2023 and 2024 were two, 25% kind of plus equity market numbers. So you want to be contrarian to some of these indicators, and that's very foundational to the way investors, particularly at Beacon Point, how we look at the world. I just want to highlight again, if you talk to investors, when sentiment is really bearish, in this case, you've got bullish sentiment very low, that's bearish. So you got very low, very significantly bearish investor sentiment. That's generally a pretty good time to invest. Julian's got a slide later he'll talk about, which shows one of the quantitative measures, which we've already looked at, which would be volatility, or VIX, the VIX index, which is known as the fear index in the equity markets. When that's very high, that's the time to buy. It's when people are running away from the market. It's the time to buy. When the probability of recession is very high, that's the time to buy, because it means it's already priced into the equity market. When the probability of recession is very low, you should probably lighten up. So there's a lot of ways we can, there's a lot of things we can talk about in that regard. Consumer sentiment, again, very low. Does that worry? No, these are coincident to the equity market. That is, if the equity market was high, like it was, you have higher consumer confidence. How about if you're asked about the future? Well, here's where folks have really gotten very negative. The questions asked for the Consumer Confidence Future Index is the lowest since 1980. Questions like, how do you think will your family finances be better off 12 months from now? What do you think about the economic outlook for the next 12 months? Do you think your family will be better off or not? And a lot of folks are saying no, and that the pessimism is as high as it's been since 1980. By the way, I mentioned earlier we were going to talk about how consumer confidence is affected by your party affiliation. In the Obama administration, certainly Democrats were more enthusiastic about the expectations of the economy than Republicans, Democrats in the blue, Republicans in the red. Trump won is when you started to see some pretty meaningful bifurcations. Biden, positive during Trump won, very negative consumer expectations during Biden, and now reversed. So you might, there's no better indicator of how you feel about the economy than if you ask first what your political affiliation is. Let's talk about inflation real quick. We got a couple of numbers here. These are the core inflation number and the headline. They're still above the Fed's 2% target. We're going to get another release next week. It was moving lower pre-tariff announcements, but this is also a backwards-looking indicator. And we haven't really seen the impact of any tariffs yet. We're not really quite sure what's going to get implemented. Again, I think it's going to be a total of about 15% on imports, and the baseline 10% tariff, that's got to be there, because I think the administration wants to use that as an alternative source of revenue to get the tax bill done by September. So we're going to hear a lot about taxes and the budget reconciliation process in DC. I've already been to DC, I'll be back, I'm sure, to talk more about this with policymakers and other folks so we can try to stay up to speed on what exactly is going to get implemented and what can be implemented. I think that's really important when navigating a very volatile and uncertain environment, is to get all the information sources lined up and make sure we have as good a information set as anybody, and probably better. So I think that's important to note. Here's the thing, and I'm just going to swing back to the Federal Reserve for a second. If you fired Jay Powell, these numbers would become unhinged. These are short-term or intermediate-term and then longer-term inflation expectations. And one of the things that the Fed needs to do to keep interest rates low and keep the economy humming along is to maintain their inflation-fighting credibility. And that would be severely damaged if they weren't an independent entity doing the best they can to navigate, through massive uncertainty. So the Fed will hike rates substantially if inflation expectations start to become unhinged, which they were back in March of 2022. Back in March of 2022, you had intermediate 5-year inflation expectations pushing towards 4%. The Fed won't allow that. They can't. They can't allow it, because inflation expectations tend to be self-fulfilling. So this is the Fed's credibility metric. It's the gray bar, which is 5-year forward. It's inflation over the period from 2030 to 2034. That's what the expectations of the market are. This needs to be about 2%. For the last 20 years, these numbers have, both intermediate and long-term inflation expectations have not coincidentally, hovered around 2%, which is the Fed's target. Why? Because they're a credible inflation-fighting central bank, and you need that and you want that. I'm just going to say this is like PCE core. These are two other inflation metrics beyond consumer price index or the CPI. PCE core is what the Fed cares about. The momentum here has kind of shifted a little bit, partly due to the tariff announcements, partly due to other things. And super core, which is all Jay Powell talked about post 2022, the momentum there has also shifted, which is to say the 3-month number, which represents momentum, is higher than the year over year. So the year over year number is actually looking okay. It's down to 3%, a little more. Same with the PCE core. The year over year number is back in the sort of the yellow, but on the right track zone. But the 3-month numbers are above the year over year, and that's not good. So to put it all together, what's the Fed going to do? Nothing. Nothing. They didn't do anything yesterday. The announcement. The press release that came with the announcement of not moving interest rates was not surprising. Came in, identifying greater uncertainty, identifying the cross currents related to their dual mandate, which is to support the labor market, support the economy, while at the same time maintaining price stability or keeping a lid on inflation. And those two things come into conflict occasionally. And they're potentially in conflict now. That's what stagflation is. It's the worst case scenario for a central bank. So right now, with the market is pricing in little bit of a chance of a rate cut, 20%. I don't think it's going to happen in June. Depends on the data, and the Fed will always remain data dependent. And between now and the next Federal Reserve, the FOMC Open Market Committee meeting, where they'll set interest rates, which is on June 18th. Between now and then, we're going to get a lot more data. We'll get another labor market report first week of June. We'll get some more inflation data next week, and we'll have 2 inflation prints between now and June 18th. So we got a lot of data to go. So I don't put a lot of stock in that, but if you as a Fed watcher, as someone who's our team is laser beam focused on the Federal Reserve and their reaction function and why they do what they do, because it helps us manage the money better. I would say between now and September, you'll see a rate cut, and probably 1 or 2 more between now and the end of the year. So maybe 1 to 2, maybe 2 to 3. So say 1 to 3 rate cuts between now and the end of the year, and maybe 4 rate cuts a year from now. And that's kind of what this data suggests, that if you look out 12 months, the market's pricing in 4 rate cuts. So I'm going to spend 3 minutes or less talking about the budget deficit situation and the debt ceiling, because we are going to have to hear about the debt ceiling this summer. And I want to highlight this last line here. Right now, the public debt outstanding is 36.2 trillion. The debt ceiling 36.1. The Treasury Department has instituted extraordinary measures, accounting measures, to make sure that we're not inofficially violating the debt ceiling, which is a really silly rule anyway. The debt ceiling should be abolished. It's been raised 78 times since 1960 by these amounts. The most recent was a bump of 4.7 trillion. That started January 2nd of this year. So we're above the debt ceiling. It's not a really good rule. It never was intended to be used as a negotiating tool to enforce fiscal discipline. It was never intended to be anything but a facilitator of getting Congress to, once Congress has approved it, it's got to go. And if you've already approved the payment, you should probably, just assume that if we don't have enough tax revenue, we should issue debt to cover it, so that we can actually pay our bills. Default's not a possibility. Don't even give it a second thought. This is a problem. In the long run, deficits lead to higher debt. And right now, the Congressional Budget Office, or the CBO, has predicted that we will have primary budget deficits and budget deficits. These are primary budget deficits. That's net of interest expense, is the gray. For as far as the eye can see, we haven't had a surplus since 2001 in the budget deficit. So these, during 2020, 2021, 2022, strong fiscal stimulus, but this is a pro-cyclical deficit that has no place. The economy was strong. Before April 2nd, the economy was humming right along, and we were looking at another 2% kind of a GDP year. You shouldn't be running a 6 or 7% budget deficit. Right now, the new updated numbers are closer to 7% for fiscal year 24 fiscal year 25 budget deficit ending September. It's just crazy. And we shouldn't do it. And we're going to lose reserve currency We won't. There is no substitute. We're going to get to that in the next section, which I'm going to try to jump right to. This is, by the way, is general government debt to GDP. Actuals were 123% going back to 1940. Haven't been there since World War II. And the CBO estimates are for debt to GDP to get to 144%. This is the real number that matters. If the total government debt's 36.2 trillion, and it is, interest rates were really low for kind of the 4 years around COVID. So that's fine. If interest rates are 1.5%, you can have this amount of debt because the dollars paid on the debt are low. That's kind of where we were down here, less than 400 billion in interest expense. But now interest rates have spiked because the Fed needed to fight inflation, and we have increasing debt stock. So the cost of the debt and the debt stock itself have both increased dramatically. That means the interest paid on the debt is skyrocketing, and the estimate for 2034 is $1.5 trillion from less than $500 billion in 2021. Right now, the interest we're paying on our debt is more than the military budget for the entire U.S. military. It's kind of nuts. And it's going to constrain the administration at some point. This is a chart I've been presenting for the last 6 months. It basically shows how much of a percent of all the tax revenues we're getting goes back out the door to pay coupon interest for the debt. So how much is our interest expense as a percent of the total revenues, tax revenue of the government? And the answer is once you get over 14, it tends to become binding, or at least it has been historically. So going back 40 years, when we were at 14% of interest expense as a percent of tax revenue, and it's been since 96, since the president and the administration were forced to consider austerity, you kind of have more restrictive policy. And that restrictive policy allowed us to actually balance the budget in 2000. We're well above 14 now and heading towards 20%. So you can't have accommodative fiscal policy anymore. It's the highest on record. And since it's a beacon point macro in markets, it wouldn't be complete without an equation. This is the IMF's debt sustainability equation. I put it up here for informational purposes. It was the thing that ruled my life when I was the head of sovereign research at UBS. And I'm here to tell you it's a very useful tool when trying to figure out what our debt dynamics are. What is the probability that we can sustain our debt here in the United States by moving some of these things around? For example, what if real GDP goes up or down? What if our real interest rate on the debt is higher or lower than GDP? Here's the key to this entire thing. If GDP growth is higher than the real interest payment of your debt, if real GDP growth is higher than the real interest rate on your debt, then you can sustain the debt. It's nice to have a primary budget surplus as well, but you don't need it. And we've done a ton of work here, thanks to Nick Coletta, to get us in shape to show some scenario analysis. I'm just going to leave this in the next slide as read because we're going to run out of time here pretty soon. We want to make sure everyone's questions are answered. But in terms of like the scenarios, 134% debt to GDP by 2035, that's the baseline. If you manipulate some of the growth and inflation scenarios and take them all together, I mean, it could be as nice as 114. We could actually improve upon our debt situation, or we can, rocket towards 150%. And then you can change the primary. Here's the key to this chart here. If you run a primary budget surplus or just a 1% deficit, a 1% primary budget deficit, you go from 100. I think our starting point here is 124% down to 103%. That would be very attractive. If we can get below 100%, that would be very attractive in the next 10 years. Very difficult to do. It would mean balancing the budget, which again is going to likely take entitlement reform. Julian, I'll get right to you. This is the other two scenarios we're looking at. Again, the baseline takes us to 134% debt to GDP. If interest rates go higher, well, then we're kind of out of luck. The base interest rate here is 3.5%, but if rates go back down to 2, again, we can sustain the debt and actually reduce it. Here's the big one. If you get inflation, a burst of inflation for 3 to 5 years of about 6%, that is the thing that takes your debt to GDP from 124%, the baseline, down to 74%. What I want to highlight here is there are tools to deal with our debt to GDP ratio, which is important if we want to maintain safe haven status. Those tools are in the hands of policymakers, both fiscal policy and monetary policy. And you can do it. But the tried and true method of liquidating the real debt burden and getting our debt sustainable includes a combination of factors. Fiscal adjustment, which means fiscal austerity, it means balancing the budget or getting closer to balancing the primary budget deficit and making that as close to zero as possible, and letting inflation run a little hot. This has just a ton of implications for investment over the course of the next 5 to 10 years. Inflation is likely to be higher than expected right now because it is the tried and true method of financial repression to reduce your debt levels. Julian.
Yeah, Michael, we have 20 minutes left and we want to get to the portfolio positioning in a high volatility environment. But first, quickly, can we talk about the US dollar? Is it still the reserve currency?
It is. It's going to stay the reserve currency. I think we've dented our safe haven status, but right now there is no substitutes. Almost 60% of transactions that are done in foreign exchange or the foreign exchange assets. If you did a survey of the European Central Bank, Bank of Japan, Bank of China, Brazil, Turkey, whoever, you go to their central bank and you see what's in their safes, it's going to be U.S. Treasury securities. 58% of all reserve assets, that is, these countries hold U.S. Treasury securities as their reserve currency to manage their own currency issues and their economy and smooth out the business cycle in their economies. They use the US dollar because it has historically been the place to invest. What makes you the reserve currency of the world? Big economy, strong Navy to keep shipping lanes open, open economy, so it's investable, rule of law, policy coherence, credible central bank. And here's the big one, fiscal probity. You have to manage the money. You have to manage your budget appropriately. Otherwise, you're going to, and trade's a part of it too. If you have a huge budget deficit and a huge current account deficit, and the current account means you rely on foreigners to fund your budget deficit, or you export more than you import, that creates a current account deficit. You need to do other things to manage around that in order to retain safe haven status. But let me go through those again, at least the ones that have been called into question here. So having an independent central bank is hugely important to maintaining safe haven status because you don't want to invest in a currency that's going to get inflated away, devalued. It's not going to go, no one's going to confiscate the currency. They call inflation confiscation by different means. So your purchasing power is being confiscated by inflation. That's why you need to maintain a real rate of growth of your investments, not a nominal rate of growth. You need a real rate of growth in your investments net of inflation. It's because you got to keep up with inflation as a bare minimum. So the point is, if you're the world's reserve currency, you need an independent, credible central bank. You need a fiscal government that understands the benefits of having a low budget deficit, not a pro-cyclically 7%. During a period of time when the economy is growing, a budget deficit of 7%. It's tragic, is what it is. It's unheard of, and it needs to be dealt with for sure. But the only way to do it, I think, is to deal with the entitlement programs, and that's the third rail of politics. Anyway, 60% of the assets out there used in the global central bank reserve system are U.S. dollar. 24% of all U.S. treasuries outstanding are held by foreign central banks. So 3/4 of the treasuries are held by investors, both in the U.S. and outside the U.S. Fully 1/4 of all U.S. treasuries are held by foreign central banks. And in terms of, if you look at the holdings of every single central bank out there, China is the biggest holder. 12% of their assets, 12% of their foreign central bank holdings are U.S. Treasury securities. The rest of the world, 70%. Japan's 13%, China's 9%. The UK is just under 9%. So most U.S. Treasuries are held by investors across the globe, but the biggest holders are China, Japan first, China, and the UK. Here's why we may have called a little bit of that safe haven status into question. What you normally, this, by the way, goes back 5 years. It's the 4 years. It's the U.S. dollar index is in the blue and the U.S. Treasury yield in the orange. They're fellow travelers. As interest rates rise, U.S. dollar denominated assets become more attractive. Something weird happened around Liberation Day. You had the U.S. dollar decline dramatically, and at the same time, people were dumping treasuries. And so interest rates rose very dramatically. It was a 99% percentile move in treasury interest rates on April 8th and 9th. and it's what caused the administration to walk back the reciprocal tariffs. This spike in interest rates is what proved to be a binding constraint on the administration's efforts to implement what most economists would agree was a relatively chaotic set of tariff announcements, not reciprocal, and using an equation that wasn't orthodox economics, to be perfectly candid. It was a strange way to calculate them, and as a result, you had this very unusual move with interest rates spiking higher at the same time the U.S. dollar was declining. It kind of indicated, and I'm just going to show one more chart to highlight that. This is 50 years of weekly data going back, or 45 years of weekly data going back to the 1980s, which shows a scatter plot. In the upper right-hand corner, you have interest rates going up and the dollar increasing. In the bottom right-hand corner, this one I'm going to focus on, rates are increasing and the dollar's going down. How weird was April 7th through April 11th? It was a complete and total outlier. And it was indicative of, a very unusual set of circumstances, probably the selling of U.S. dollar assets, or the other explanation, and I think this has a lot of merit too, was the unwind of a very levered treasury basis trade, very popular trade within hedge fund land that got whacked because of the volatility of interest rates. But two things, it's either one or the other, or a combination of the two. It's either a loss of confidence in the U.S. dollar briefly. It's resumed. I mean, we're back on track, in my opinion, to a certain extent. But some damage is done. Every time you implement a policy that does damage to your safe haven status, the institutional memories are long. Julian, did you have a question?
I guess two questions. First one, briefly on sovereign selling treasuries.
Yeah.
And then the next one on gold, do you see gold where does it fit in our asset allocation?
It doesn't generally, because we've taken a position that you start your asset allocation with the same assets that reflect the growth rate you need to achieve your financial objectives in the financial plan. If you're an institutional client, that means to achieve your spending rate. If you're a private client, it means achieving the endowment you need between now and age 95 to get to age 95 and not run out of money. So by tying our portfolio construction process directly to the financial plan, we don't need to include a lot of other assets. We just need access to primarily publicly traded assets. That's publicly traded stocks, bonds, and then private assets in alternatives. So the combination of public assets and private alternative assets is enough. You don't need higher volatility assets that generally fall in what I would call the commodity space, including gold, other commodities, natural resources, things of that nature. You don't need them. Sometimes they do really well, but they're not necessary to achieve your objectives. That is the most important point I can make. There's always something that's going to, rise in value 30% that we're not going to own any of. And we're A-okay with that because it's not because we don't have an information advantage on gold. I don't think anybody has an information advantage on gold. Speaking of gold, I mean, the gold price here from the beginning of the year, it's up 28% year to date, and 10% from Liberation Day to the peak. It's given up a little bit now. Japanese yen is another safe haven asset. By the way, we put gold in the yen. I could have put Swiss francs up there too, or the euro. They're all the same. They were all bought, these currencies or currency substitutes. Gold is a currency substitute. Were bought by selling U.S. dollar denominated assets. But these things happen, and then they either revert to the original equilibrium or there's a new equilibrium. And I think there's probably a slightly new equilibrium now in U.S. safe haven status. And the new equilibrium is likely to reflect a higher risk premium for owning U.S. dollar assets, in part because we can't control our fiscal spending because of policies related to the independence of the Federal Reserve or potential threats to Fed independence, which I think are would be devastating. And to be honest, sanctions that weaponize the U.S. dollar payment system, particularly in Russia in 2022, has caused other countries to want to move away from dollarization because they want to not be subject to their constraints that being dollarized and having the U.S. dollar as the only reserve currency. Now, here's the really important point to make. We have a poor fiscal situation, but we're gonna muddle through. There isn't a substitute for the U.S. dollar anywhere in the globe. It doesn't exist. And because it doesn't exist, we will retain reserve currency status. Full stop. You have to remember, currencies are not a zero, they're a zero-sum game. They're a relative game. You can't say the US dollar has lost its safe haven status without pointing to the currency or currency substitute. It's not Bitcoin. It's not gold. You can't, it's not a means of exchange. And it's not neither one of those is a very good store of value, which is required for a currency substitute. So to put a fine point on it, to say that the US dollar is no longer going to be the reserve currency, I'm going to follow up with, okay, what is? And the answer is there isn't an obvious choice, and there won't be for decades. You need too many things to be the world's reserve currency status that other countries just don't aspire to or will not be able to manufacture or produce. You need 30 years of, institutional history of deep liquid treasury markets, deep commitment to the rule of law, et cetera, in order to be the reserve currency. And that's just, there is no substitute, and there won't be. So I would say for folks that are looking for alternative to the US dollar, we've probably done a little damage and will continue to do damage to our status as a safe haven, which will result in a higher risk premium to hold US assets and a little bit of an itchier trigger finger on the part of foreign investors to sell US dollar denominated assets. But broadly speaking, there are other things that are going to determine whether US dollar assets or non-US dollar assets are going to perform well over the next 5 to 10 years. And that's something we want to address in the next section. So I'll just highlight a couple of things. You want to retain reserve currency status, because if you don't, you got real problems. We've earned our reserve currency status. We have to continue to earn it. It's meant a sizable structured demand for dollar assets and, frankly, a lower cost of capital here in the U.S. That's the reason you want to be the reserve currency. Julian.
Yes, let's go to portfolio positioning. And then one question that comes back a lot is about international exposure in equities.
Yeah.
How do we feel about U.S. versus, IFA and emerging markets?
The U.S. exceptionalism thesis got probably a little overbought in the last 3 to 5 years, and certainly into 2024, as U.S. assets completely outperformed international assets. But and a lot of investors tend to have a home bias. They see what has been happening, and they want to own that, the thing that's performed. I go the other way. As an investor, it's important to sort of step back and look at the valuation metrics and say, what is trading rich, cheap, and fair? And as a result, our portfolios are well diversified. They're going to have a lot of international exposure, because you just don't know when international is going to do what it's done in the last 4 months, which has significantly outperformed the U.S. And you want to be involved. You want to have that diversification benefit for one simple reason. Diversification is the only free lunch. Stephen Marshall, head of asset allocation, will tell you. It's the only free lunch in finance. So don't ignore it. Be diversified. Have a diversified equity exposure. Use the global market as your opportunity set. And that will achieve your objectives. Again, I'm going to go back to something I said just 10 minutes ago. To achieve your financial objectives, whether you're an institutional looking for investor looking for a spending rate, or you're a private client looking not to run out of money in retirement, both of those objectives can be met most effectively and efficiently if we tie the portfolio construction process to your financial plan, which is the basis of our portfolio construction process. We start with a plan or an investment policy statement, and that dictates the assets that we're going to invest in, and in some cases, the proportion of the assets that we invest in. And then you stay invested. And then 30 years from now, you're happy because you didn't run out of money. And you close your eyes in many cases and kind of ignore the noise and try to find the signal. Because right now, what you're seeing is a lot of noise. The administration's moving fast, it's trying to break things. The markets and approval ratings are going to be binding constraints. So I don't think we've seen the end of the volatility, but we have seen the peak. And just remember, everything needs to be discussed in light of how the economy sets up for the November 2026 midterms. And just really to put a fine point on it, the bond market has proven to be an incredibly effective binding constraint on heterodox policy. So you can't control what the administration is going to do. They're in charge, and they're going to be in charge for another 1,300 days. But you can try to find the signal from the noise. Stay invested. That's what we're trying to do. Julian, did you have a question?
Yeah, I was going to ask if you can summarize in a few minutes why we are risk on and what's the summary of our outlook for the next 12 to 24 months.
Yeah, I think that's a good summary here of the macro outlook, because you want to be risk on when you think you're going to avoid a recession. And we talked earlier about how most of the policies that we've discussed related specifically to tariffs and cost cutting and immigration and potentially interfering with the independence of the Fed, those have all been growth negative. But taxes and deregulation are coming in the second half. So that gives us a little bit of confidence that, and the equity market's already, proven to be reflecting some of this, because as I said, we're back to where we were April 2nd. We're not, all the way back to the peak. We're not near that peak yet. They're 5% plus or minus. But the economy should avoid a recession, and the president and the administration will do what they can to avoid a recession, because sometimes you can't course correct, and you may want to move fast and break things. But if the Fed cannot come to the rescue, and they'll support the economy when they need to. If the unemployment rate starts rising, they'll lower rates. They won't lower rates just because the president is tweeting on True Social, but they will lower rates if the unemployment rate goes up. So, but it may not be enough to get the economy and the markets back on track ahead of the November midterms. So the November midterms really should be the focus of any conversation about the outlook for policy and how the policy will affect the economy. So I do think you're going to get, you're going to avoid a recession. You're going to have a little higher inflation. So real assets should have a place in your portfolio. That's infrastructure primarily, and maybe tips and bonds. Tips are not cheap right now, but the Fed's likely to cut rates, maybe 1 to 3. But you remove the election uncertainty, but you haven't removed the policy uncertainty. So in terms of the positioning, value and quality likely to outperform, large caps likely to outperform small. It's hard to say whether from here the U.S. is going to perform better or worse than non-U.S. equities. So our view is, be a little bit overweight both, and because being risk on in an environment where the Fed is likely to lower rates a little bit, and you're likely to avoid a recession, especially given the volatility, we've got an opportunity here to selectively add to risk taking. It's not an on or off; it's a nudge. We've nudged a little bit into risk taking. We want to stay there for the time being until something derails that thesis. So with Fed funds slowly normalizing and long-term bond yields elevated, it's prudent to probably, have a few less bonds in the portfolio and a little bit more equity in the portfolio. But no matter what the environment, you should always be in alternatives. Julian, I was going to try to give you time to explain this chart. Do you want to, or do you want me to just say what this means?
I think it's pretty self-explanatory, but I guess what we wanted to show here is that, there hasn't been that many events of very high VIX or volatility in the equity market. So this is always a good indicator to keep an eye on. And you can see that when we had with the Liberation Day on April 2nd and the following days a peak at 52, that was the 10th time only since 1991 that we went above 40. And clearly that shows a lot of scare in the market, in equity market. And usually when there's scare, it's a great time to actually get involved and not panic. And as you can see from the performance in the table below, that shows how much the S&P 500 has returned from this point in time. So, the next 3 to 6 months, you had some negative numbers, but of course, the longer the investment horizon from there. So if you take more like a long-term investment approach, which is really the way we recommend you invest in equities in general, after 24 months in all scenarios, you were up somewhere from 2% to 60%, and on average 37%. So just keep an eye on the VIX as these moments of uncertainty create buying opportunities.
Yeah. So bottom line, sometimes it's best to run, towards the fire if you're investing and go against the conventional wisdom. When the fear gauge is high, you generally get some pretty good outturns. So this summarizes our outlook. Again, it's really important to note we're slightly risk on, with a stagflation, and we're underweight bonds to fund a little bit of the risk on position. And really, the volatile markets recently have created better entry points. The U.S. economy is a going concern. It's the best place to invest. Europe is also a good place to invest. Asia is a good place to invest in periods of time. It just depends on what you're trying to accomplish with your portfolio. If you're looking for, to to move assets in very large proportions into the things that we think are going to outperform over the next 3 to 6 months. That's not the way investing works. The way investing works, if you're trying to achieve an objective as opposed to an absolute return, highly risky, highly levered portfolio positioning, if you're trying to achieve an investment return, it's not necessary to take any more risk than you need to get that level of return that you're comfortable with. So by tying our portfolio construction process, by adding assets to the portfolio and not getting involved in others, a lot of other assets that are out there that are typically things to be, invested, I guess, that were created by Wall Street or something. I don't know. It's not necessary. Good investing is just blocking and tackling. It's not very exciting. And our goal is to achieve your objectives over a 3 to 5 or 10 or 15-year investment horizon, every 3 to 5. So if that's what you're looking for, that's what we're doing. So remember, the volatile situation we've seen in the last 4 months or 3 months is not likely to persist. When volatility is high, it tends to come down, and that's generally a decent market for equities. If we avoid a recession and the Fed can, starts to normalize rates again, we should be in pretty good shape. And without volatility, you can't build any wealth. And that's really the key takeaway. So with that, we're up against the 90 minutes. Julian, any final comments or thoughts, questions?
Yes, thank you, Michael. And thank you all for joining us today. We appreciate your time and engagement, and we hope you found today's webinar valuable. So keep an eye in your inbox for an invitation to our next quarterly and macro update, which will take place on August 14. We look forward to seeing you then. Until next time, à bientôt.
Bye, everybody. Thanks for joining.